Hi, welcome to the second part of our two-part series on how to trade the gap. So in the last video, we spoke about how to identify various trading gaps, and then we spoke about the two different types of gaps that provide great trading opportunities. In this video, I want to focus specifically on how to trade those gaps. As a recap, in the last video, we spoke about 4 different types of trading gaps. We spoke about common gaps, exhaustion gaps, breakaway gaps, and runaway gaps. And what we found was that the common gaps and the exhaustion gaps are sort of dead-end opportunities. They don't really present trading opportunities, while the breakaway and runaway gaps provide very good opportunities for the most part. So I also showed you the gap trading framework, and as we can see, we have already identified the type of gap. And now we're going to move on to how to create a gap trading plan. So when you're creating a gap trading plan, you want to look at various factors, and you're going to look at the underlying reason for the gap. For instance, a gap caused by a major fundamental shift in the company's outlook, like a merger or acquisition, is less likely to be filled than a gap caused by short-term factors. Or a gap after a news announcement could be the signal of the beginning of a new trend. Next, you want to look at your time frame. Some traders look for gaps on daily charts, while others look for intraday gaps within the trading day. And your time frame will depend largely on which time frame you're comfortable trading and how much time you have to trade during the trading day. Next, you'll be looking at the indicators used to identify what trading gap it is. Once you understand the context of the gap, you're going to look at the volume. So a high volume after a gap is generally seen as confirmation that the gap will not be filled immediately and that the new price represents a new consensus on value. You'll look at the chart pattern. For example, a breakaway gap will break the chart pattern and will start a new one. You'll look at indicators such as stochastics and the RSI to confirm whether the gap has place to continue. And this would be more important if you're looking at a runaway gap. A critical part of a gap trading strategy, and any strategy for that matter, is your risk management. Where do you set your stop losses and your take profits? This will depend largely on your risk appetite, but it'll also depend on where you find certain key levels. And on that note, you'll want to look at various key levels. Where is the prior support or prior resistance? Do you expect it to hit a psychological handle or a whole number? All these factors need to come into play when you're performing your analysis. Once you've performed your analysis, you then need to look very carefully at your triggers. And to do this, you'll want to look at how the price is responding to the gap. Does it confirm your thesis? Does it test the highs or lows? And is it moving above them? Once you find the evidence stacking up, you can then select your trigger. Now, there are many different triggers that traders use, and this will be quite unique to your style of trading. Triggers could be a test of the lows and a high break, or it could be reversal candles. It could be a break of a trend line, and always the stop loss should be a key consideration. So you could go on the break of the low, then as it comes back, take the next green candle and place a stop just below the current low. And the last step, of course, is to manage your trade. This means managing your risk, and this means monitoring your trade and seeing that it is fulfilling the criteria that you thought it would. If the volume falls flat and there is no movement after an hour, for example, that the market starts to get choppy or that it's not doing what you expected it to do, then it might be time to get out of the trade. Sometimes it's not so easy to identify what type of gap it is. It could look like it's a runaway or breakaway gap, but it could end up being an exhaustion gap. In summary, in order to trade the gap effectively, you want to identify the gap type. You want to formulate a plan of action, you want to wait for your trigger, and of course you want to stick to your plan. Common mistakes to avoid including ignoring the overall market trend, trading the wrong gap type or not identifying the gap correctly, and not managing your risk. Thanks so much for watching. If you have any questions, please send them through to us at fxscouts.com, and please remember to subscribe and like.